In this video, we are going to go through the chart of accounts flow. Okay, how it works. So we'll start out, first of all, in the chart of accounts area. Now, I hope that you all are aware of this, right? So we have the hierarchical view, which is basically looking at all the accounts, right, with the headers and the subs showing. We also have the flat view, which you can see down here, and you can see when I do that, right, it puts it so that the entire account number or account name is mentioned here, where it shows our headers and our subs. Okay, so again, if I flip it back to that. So in QuickBooks, we have the ability to come in and customize our columns, right, on our lists. So I want to add the account number as an example, and I want to move it up a little bit and maybe add the description and move it up. So when I do that, I can then click on the top columns here, and it's going to sort by those numbers. Now, in the hierarchical view, it will include the subs, right? Sort by the subs. So if I go to the flat view, right, it's going to sort just by this, not including the subs. So anyway, I just wanted to show you that. Now, if we've messed around with our chart of accounts, right, we've sorted by different options here, descriptions, balances, whatever it is. How do we get it back to the normal order? So up here in the top left, there's going to be a little diamond, and when you click on that diamond, it puts it back into the regular order, okay? And it's going to be in order of your trial balance, flow, and then by account number, or if you don't have account numbers, then by alphabetical for the names of the accounts. All right, so why this flow? So as I mentioned, this is your trial balance flow. So if I go run a trial balance report, it's going to have this exact same look, right? Bank accounts, current assets, fixed assets, other assets, liabilities, etc. Okay, and we'll go through all this. But that's the flow that is happening here when you put it back in its regular order, okay? So why do we do it that way? So the trial balance is really two reports added together, right? It is going to be your balance sheet, and it's going to be your profit and loss. So as you can see on these reports, same thing. I have my checking accounts first, then I've got my accounts receivable, other current assets, and it's going to follow that same flow of when I put it back in its normal order here. Okay. Okay, so when we're looking at this, okay, you're going to have your bank accounts up top, right? And the bank accounts are considered an asset, and they're a current asset because a current asset is anything that we can receive or get within a year. Cash, right? We could probably go to the bank and have cash. We can write a check today. It is obviously a current asset that we have on our books. Okay. Then we have our accounts receivable. Hopefully our accounts receivable is something that we can receive within a year's period, right? We'll be able to collect from our customers within the current year or within a year, right, from the posting date. Then we have our other current assets. So inventory would fall under there, any kind of WIP, prepaids. So all of these things we expect, right? Inventory, hopefully we expect to turn it over within a year, meaning we expect to sell it within a year. Prepaid insurance, right? Usually you prepay a quarter at a time or a month at a time, and then we amortize it within a year. Security deposits is one actually that mostly should not be an other current asset, because when we go and we rent a office space as an example, we give a security deposit, and it is for the term of the lease, right? Or the term of the rent. So if I have a 5-year lease, that security deposit I probably won't be getting back until 5 years later. So obviously it doesn't show up as a current asset. So how do we fix that? We go to our chart of accounts. We go to security deposit, right click on it and edit the account, and change it to be an other asset. Now there are some account types that you cannot change, you cannot modify, but that's obviously one we can fix. Okay, so now it's out of my current assets and into my other assets. We also have undeposited funds in here, which shows up on your balance sheet. So these are checks or payments that we've received that we haven't put into the bank yet. Again, a current asset. Moving down, we go into our fixed assets. So our fixed assets should be things that we are going, we purchase that we cannot expense in 1 year. So what does that mean? If I buy a computer, right, the computer's life is going to be over 3 years, 5 years. And so I cannot expense it in this current year because I'm going to be using it over the period of time. So that's why we set it up as a fixed asset. If you have questions on what your fixed asset threshold should be, right? Because you're not going to stick like, I don't know, paper clips as fixed assets, even though you're going to use them over the next month. Those are immaterial amounts, and we just put those straight to expenses. But if you have something, again, like a computer, so usually people have a threshold. For most small businesses, $500 is a good threshold. For some of the larger businesses, we have, $5,000 is a good threshold. So it just depends. Again, if you have questions around it, please make sure to contact us and we can help you out. So it's any one item is above that threshold. So if I buy 10 chairs for $1,000, I probably don't need to expense those. But if I buy one chair for $1,000, or I'm sorry, I probably do need to expense those. I can expense the 10 for 100. But if I buy one chair for $1,000, that would be considered an asset because it's above the threshold, it's a material amount, and I would need to depreciate it over a period of time. Okay, so fixed assets are on here, but they're not considered other current assets, right? Because it's not something that we necessarily can get rid of quickly or that we're going to get rid of within a year. Okay, and then we have other assets down here. Other assets are long-term. So let's say we have a long-term notes receivable from somebody, right? One of our customers says they need, a 3-year payback. That would be a long-term. A security deposit. We're not going to receive that security deposit back most likely within a year's time. Okay, so that's where other current assets come into play. And those are going to be all of the asset types that are in QuickBooks, right? So if I look at my chart of accounts, again, those are all the asset types that we have in QuickBooks. Then we move down into the liabilities section. Okay, so liabilities are accounts payable, most likely going to pay it back within a year. It's a current liability. We have our credit cards. Most likely we're going to pay them off within the current year or pay them down, right? We're buying and selling and moving money on them. So within a current period, within a year. So credit cards are considered a current liability, meaning they're due soon. We have payroll liabilities. Perhaps we have a line of credit that we are going to be paying back within the year. Sometimes we have notes payable, right? Those would not be current because most likely when we have a note, it's going to be paid out over several years, not within the current year or within a year, okay? And the difference there, what I'm saying is paid off within the current year means I'm going to pay it off by December 2015, right? But paid off within a year means that, today it's October and I'm going to pay it by October of next year. Okay, so those are current liabilities. And then we have things called other or long-term liabilities. And again, that's where the notes would come in play. That's most of the time what we see in there as long-term liabilities. All right. Then after liabilities, we move into the equity section. The equity section is going to be the value of the business, right? So how much they have accumulated, how much value has been accumulated over the life of the company. So every time we close out a year, right? Last year I made $100,000 net, and that gets rolled into my equity account at year end, okay, into retained earnings. And you can see it also shows me my net income for the current year in here as well. Okay, so this is the value of the business. Things that we'll see in equity, we'll see stock, right? What's the value of the stock? We'll see draws to the owners and contributions from the owners. Things that we shouldn't see in equity is opening balance equity, right? Because that's most likely should be rolled into retained earnings, right? The other thing is if that you're dealing with a partnership or have multiple owners, you wouldn't just have retained earnings. We would do a journal entry at year end to allocate the retained earnings into, or truthfully, it happens not at year end, it happens on the first of the year. So we would allocate the retained earnings into the different owners' accumulated equity, right? So if I had a 50-50 split, let's pretend it's 300,000. If I had a 50-50 split, 50% ownership, 150,000 would go into, Joe's equity, and then 150,000 goes to Deborah's accumulated equity. Right? So if we have multiple owners, it shouldn't just sit in one account. Okay, so that's the first workflow when we're looking down our chart of accounts here. The first section is our balance sheet. Now, when we're dealing with our balance sheet, assets equals liabilities plus equity, right? So you can see that here. When I merge them, I'll collapse it all down. Assets, all of my assets, current or long-term, equals my liabilities plus my equity. And that's for every business. Those two should balance, okay? I have had clients in the past, or I've had one client in the past who I don't believe is in business anymore, tell me that that is not going to work for their company. And I had to chuckle quietly. Of course, I didn't want to offend anybody, but this is how it is for every company. So you want to make sure assets equals liabilities plus equity. Now, if we're able to tie out our entire balance sheet, right, what that is telling us is that, because our net income is in here also, so if every other account on this balance sheet we can substantiate, then that means that our next report, the profit and loss, is correct. Okay. Now it may be that, something's in income that should be an expense, but the net from our profit and loss is correct. Okay. So one thing I'm sure you're thinking right now is, why is that off? So this on the balance sheet is showing us net income for the entire year. This is just showing me for the month. So if I go back to year, now those two will tie out. Okay. So the workflow, of course, when we're looking at a P&L, we're going to see our income up top. Then we're going to see our cost of goods sold. These are direct costs. An example of a direct cost is I sold a product for $100 that cost me $50 to buy, right? That's a direct cost. The advertising that it took me to sell that product doesn't guarantee me a sale, right? So that is an indirect cost, right? So cost of goods sold. So we have income first, then we have cost of goods sold, or cost of services sold, depending on what type of industry you're in. And that gives us our gross profit. And that gives us what we're left with, right, to operate our company. So then we have our expenses, expense account types. And then down here, we're going to have our net ordinary income, right? So from normal business, this is our income. And then we have some other expenses. So expenses that are not part of our normal business, right? Gain or loss on sale of a fixed asset, interest expense, interest income, things like that. So you'll see that down here below, and then we get down to our net income. Okay. So when we're looking at our chart of accounts, they follow that exact same flow. We have bank, AR, current asset, fixed asset, other asset, right? All the way down, income, cost of goods, expense, other expense. And at the very bottom, you might see, depending on if you have these features turned on, purchase orders and estimates. These are non-posting transactions. You can't do anything there. They just stick them here when you turn on or enable estimates or purchase orders in your QuickBooks file. Okay, but it's not an account you can choose. So that is the chart of accounts account flow.